Good morning, everyone. My name is Rachit Khaitan. I'm here with my co-author, Vishnu Prasad, and we're from the IFMR Finance Foundation. We'd like to introduce to you our paper on how much can asset portfolios of rural households benefit from formal financial services. And we think this is an interesting question for us to answer, especially in light of the recent policy thrust on including more and more people into the fold of formal financial services, in particular Prime Minister Modi's thrust and Reserve Bank, the Reserve Bank of India's thrust. But on the other hand, we find that the recent financial stability report released by the Reserve Bank of India in June 2014 finds that there has been a sharp decrease between the periods of 2005 and 6 to 2012 and 13 of financial savings to GDP, specifically by 5.5%. And on the other hand, there has been an increase in a 1.5% increase in the physical savings to GDP, and an 8.5% increase in valuables as a percentage of GDP, which includes gold. And in this sort of context, we thought it might be very interesting for us to examine how much, and if at all, households can really stand to gain with increased access to financial services, specifically in their asset portfolios. To set forth the agenda a little bit, after I talk a little bit more about our background and about the perspective that we hope to take with this analysis, we're going to try and answer two important questions for this discussion. One is, what is the extent composition of asset portfolios of a rural household? What does that look like? What is it composed of? And the other related question being, how much can these asset portfolios, if at all, benefit from the introduction of formal financial assets? Now, we take the perspective of a household in our analysis, and we try to sort of ask how households can use financial services or financial products to attain their goals and objectives. We borrow insights from John Campbell's paper on household finance in 2007, where he finds that households and their asset portfolios possess very unique characteristics, such as the fact that households face long but finite planning horizons, the fact that household portfolios are typically composed of non-tradable and illiquid assets, such as housing and human capital, and relatedly, households often face significant constraints on their borrowing. Now, a few key themes emerge from the literature that I thought might be very important for this discussion. One is that there are discrepancies between the ideal and the observed financial behavior of households. So specifically in the fact that household behavior is typically modeled using the life cycle framework, where households tend to accumulate assets over time as they age, but then draw down upon them as they approach retirement. Poterba and Sandwick, in their 2001 paper, challenged this fundamental assumption to find that financial assets, as in proportion to the total asset holding of a household, actually decreases as a household ages and increases as they approach retirement. Now, one possible explanation to this could be the fact that many younger households tend to invest significant proportions of their wealth in housing, which Chetty and Seidel find to be a commitments good, one that requires the incurrence of high transaction costs instead of shifting consumption away and towards. The other interesting theme is that household asset portfolios are highly diverse, and diverse in the sense that they vary widely across variables such as age, education, birth years, wealth, and residence of household members. We also find that household asset portfolios tend to be simple and predominantly invested in low-risk assets. So with the exception of housing, most household portfolios across the world tend to be invested in simple assets such as savings or checking bank accounts, time deposits, and life insurance products. And the last and probably the most important theme that emerges out of literature is that households, despite the absence of access to formal financial products, actively manage their asset portfolios. And I guess the best source of evidence that we found on this was Collins et al. In their book Portfolios of the Poor actually track the financial diaries of 250 households over the course of a year, and find that despite households' inability to access financial markets, many households demonstrate, or most households actually demonstrate, the need for the essential functions of finance, namely, finance's ability to transfer resources across time, across space, and across states of the world. And many of these households do this by using a wide range of mostly informal financial methods, such as, for instance, in India, several households use instruments such as chit funds, such as informal savings clubs, and funeral insurance groups. And so the point that I'm trying to make with that last insight is that despite the fact that households might not actually demonstrate a demand for actual financial products in the way that the market offers them today, households do demonstrate the need for the functions of those financial products. So going back to our initial question, the way we try to answer this question is to construct stylized, and I'll tell you what I mean by stylized in a bit. We construct stylized household asset portfolios that are stratified based on sources of income, and so we look at primary and secondary combinations of income. And then we use the foundations of the seminal modern portfolio theory propounded by Harry Markowitz in 1952 to compare the performance of these existing stylized household portfolios over time with the hypothetical portfolio that is composed of a suite of financial instruments, and then try to quantify, if at all, the gain to 5 occupational categories. So we try to quantify the gain associated with financial assets being introduced into extent portfolios. So going to the first question, which is to take a deeper look at what an extent household portfolio looks like today. So our analysis is based on a unique data set, and this is based on an administrative data that we obtained from a financial services provider that operates in rural districts, in 5 rural districts in Tamil Nadu, Uttarakhand, and Orissa. And this financial services provider, on average, tends to service about 56% of its resident households in its service area, to give you a sense of how representative it is. And our sample consists of about 143,000 households, which are serviced by 201 branches. And this financial services provider collects detailed information about every household at the time of their enrollment, on their income, on their expenses, and their assets. So using this data, we construct our notion of a stylized asset portfolio. And I'm going to spend a little time on this slide because, so firstly, I want to make clear that this stylized asset portfolio does not represent an actual household. But this stylized asset portfolio is really composed of the median holdings of each asset category across all the households in the data set. So for instance, the median value of electronics is 7,000 rupees across. So the median value of electronics as an asset category is 7,000 rupees across all households in this data set. And the median value of land is actually 0 across all households in this data set, suggesting that most households, or at least all households up to the 50th percentile in the distribution of households, do not possess any form of land. We've also classified each of these asset categories into two broad classifications, those being consumption assets and investment assets. And we define those as follows. So consumption assets are those assets that households primarily use for the sake of their own consumption and whose value households draw down over time, as opposed to investment assets that households use for the purpose of income generation and or to actively trade and manage their portfolios. So something to notice here is that we've actually included house in our consumption assets bucket, and although house is typically known as an investment asset, the reason we do this is because we look at the value, or the way the financial services provider allocates the value of the house is distinct from the plot of land on which it is situated. What I mean by the investment assets within the investment assets bucket is just the existing financial products that households might hold, which with the financial services provider, which includes the national pension scheme and the money market mutual fund, which is 0 for the typical household. We then go on to classify all of our households by primary and secondary occupation, which pertain to the highest and the second highest sources of total household income, respectively. And so we classify these into 9 broad categories. You have labor, you have agriculture and allied, you have business, salaried, those that are working abroad, professional, migrant, non-earned, and unpaid and unemployed. And by non-earned, we mean those households whose highest source of income is derived without the use of their human capital. So those could include income from rent or from pension products. And by unpaid and unemployed, we refer to those households whose whose household members consist of either students or housewives or both. So notice here that a little more than half of our sample actually consists of households whose primary occupation or primary source of income is labor. So using our occupational classification as well as our notion of a stylized asset portfolio, we construct household typologies, and we restrict our analysis to these 5 primary, secondary occupation combinations, which we refer to as household typologies. So here, by agriculture only, we mean those households that have agriculture as their primary and sole source of income. And then you have labor only, then you have salaried in agriculture, which have salaried as their primary and agriculture as their secondary source of income, business agriculture and labor agriculture. So notice here, it's very obvious here that within the investment assets bucket, household asset portfolios are dominated by land and jewelry. So especially in the agriculture only category, you find that land forms the highest, or these households concentrate most of their wealth into land, and the labor only category concentrates most of its wealth in jewelry, which is nothing but gold. With that, I'm going to turn it over to my co-author Vishnu.
Rachit sort of laid down what the first question is all about, which is what do the current asset portfolios of rural households look like? What we're going to try and do with those asset portfolios is to estimate what is the return and risk structures that they see currently, and what is the potential gain that they would see if they were replaced by financial assets. So in order to do this, we concentrate primarily on the asset classification that Rachit mentioned as investment assets, which consists of land, livestock, and gold. So for estimating the return on land, we unfortunately do not use primary data because we couldn't find data for these particular districts. We instead resort to like a theoretical estimation of the return on land. And for this, we make the simplifying assumption that all land in our data set is composed of agricultural land. And hence, the value that's derived from that land is from agriculture. So we base our estimates on Chakravarti 2013, 14,500 output per acre for a basket of 44 crops. We also assume that income per acre is 35% of the value of the output. Assume also that agricultural productivity increases at about 2.35% every year. We model one source of risk into this, which is the risk of rainfall. We assume that a 1% deviation from mean historical rainfall leads to a 1% decline in output. And we also model in drought or flood events by on the principle that if rainfall varies in excess of 1 standard deviation above or below, it's classified as such. The other physical asset that we try to model the returns for is livestock. In this, we use 3 primary revenue streams, which are milk, manure, and the sale of the calf. The costs include purchase price, fodder, medical expense, and the cost of insemination. We do not include the cost of labor for maintaining the livestock. The purchase price of the cow is assumed at about rupees 20,000, which corresponds to the market value of this breed of cow. We assume a life expectancy of 10 years, and we model 2 sources of risk, which are morbidity, which we define as the incidence of a foot and mouth disease, and mortality. Mortality and morbidity rates are from primary research conducted by Banger et al. In 2013. For gold, we depend on historical data, which is over a 10-year period from 2003 to 2013. So with these, we sort of simulate the value of land and livestock, and the return and standard deviation that you see on jewelry here is historical. So we see that jewelry gives you about 14.5% annual return with a high standard deviation of about 18%. Similarly, livestock is also very risky, giving you a return of about 10.2%. Land in our estimation has come low risk, low return asset, so 2.5% annual return. Now, with these estimates, we apply these return estimates to find out what the portfolio return is on each of these stylized typologies. We find that labor-only households have a high return, high risk asset portfolio mix. This is primarily, as Rachit said, because they are invested 95% in jewelry. All the other households see somewhat similar risk and return structures, varying from about 8.6% to 7.6% at similar sort of risk levels. Now, with this, we move into sort of answering the question of what is the hypothetical gains for these households from the inclusion of formal financial instruments. Now, for this, first we introduce two insurance products into their portfolio. These insurance products are rainfall insurance and livestock insurance. We assume that the annual premium on rainfall insurance is 10% of sum assured being any change in the value of output from mean historical output. For livestock, we assume that the annual premium is 5% of the initial purchase price of the cow, and the payout in case of the death of the livestock is the initial value. So with these, we sort of re-estimate our land and livestock models. We see, particularly in the case of livestock, that there's a huge reduction in risk by about 8.5% and a slight increase in return at about 1.8%. Risk on land reduces marginally, and returns also increase marginally. With these, we plot the efficient frontiers for both the current portfolio that these households use and the portfolio of physical assets with the inclusion of insurance. And as you can see, the physical assets with insurance outperforms what they currently hold. We take this analysis a little further by completely replacing their current asset portfolios with a portfolio of financial assets. We include 6 financial assets, and we later add the National Pension System Swavalamban into this. So these assets have been chosen to provide the household with liquid tradable assets. So we use the similar design as we saw in the case of insurance. The only assumption being here that the standard deviation on asset portfolios remain the same. That is to say that the risk preference of these households do not change in the case of a complete replacement. What this allows us to do is to calculate what the maximum potential gains from financial assets would be if they were in fact replaced. We see that there's a change in return which varies from about 2.02% to about 3.61% in the case of agriculture-only households, at the same level of risk that they were carrying on their current portfolios. We do a similar exercise as we saw with insurance to plot the efficient frontier of both physical assets and financial assets. It's interesting to note that in comparison to even their current portfolios, the asset allocation mix that these households use are inefficient, that they don't lie on the frontier. This could be partially explained by the fact that physical assets are very lumpy investments, and it might not be possible to hold the number of assets that's at the frontier. But it's clear that from a replacement or a shift to financial assets, households tend to gain substantially higher returns. And conversely, they could attain the levels of return that they are currently getting at a much lower level of risk. We do a similar estimate with the inclusion of the National Pension System Swavalamban. Unlike the earlier case, we assume, since the NPS is an illiquid and non-tradable product, that the maximum a household can invest in the NPS is 20% of their entire portfolio. And we see that with NPS, they stand to gain much higher returns than they currently hold, and even the earlier frontier that we saw. Now, the key point that we try to make in the paper from this analysis is really that the gap between these efficiency frontiers really shows us what the welfare loss to these households are from their exclusion from the ambit of the formal financial system. And this goes back to the policy thrust that Rachit sort of started with. We feel that this lends a lot of credibility to why that policy is so important. It's clear from our analysis also that households are primarily invested in what we call local assets that are highly correlated with the performance of the local economy. And substitution to financial assets could help them diversify this risk away by investment in national assets like stocks. Before I conclude, I'd like to point out a few limitations of the study. This is to primarily set a sort of stage for some of your input on what we've done. As I said, the valuation of land and livestock are not based on primary data. It's based on theoretical estimation. It would be, we feel that the analysis would be much more robust if, in fact, primary data was used. The portfolios of the stylized household that we use contains data that's collected only from the RFI that we have data from. What this means is that there could be financial assets or even other assets that we are potentially excluding, and that the portfolios that we presented earlier might not represent a complete picture of the asset allocation of rural households. The analysis also excludes other important financial instruments that could provide tradability, liquidity, and diversification in such a markets such as corporate bonds, triple MFs, and gold ETFs. We could not find sort of historical monthly data on this. We hope to update the paper with the subsequent draft with analysis that includes these important financial instruments. The estimates also do not take into account other transaction costs like brokerage fees, commissions, and taxes on financial assets. So some of the estimates that we saw earlier could in fact be overstated because these have not been taken into consideration. We'd like to conclude with one of our favorite quotes. It's from Robert Schiller. It says that modern finance is a central pillar of civilized society, and for society to fully realize its promise, finance has to be expanded, democratized, and humanized by giving people the ability to participate in the financial system as equals. Thank you.
Thank the authors for a really landmark study in the sense that this is the first time we are actually witnessing stylized facts about how rural households in India, with a broad sample, perform vis-a-vis their asset portfolio. We're all traditionally used to studying households and individuals who actually invest in stock markets, but perhaps we don't look at the poor households in the same way as we should be. And I must thank the authors for bringing this very important empirical observations to document about the Indian households. The central idea of the paper is essentially doing something that's really hard across the world, and it's just not in India. So measurement of household portfolio in developing countries is extremely hard, partly because of paucity of data, partly because of the merge, the gray area between the real and the financial world in the life of a household. So to a large extent, you may not be able to differentiate between what is an investment asset to what is a consumption asset if the woman of the household is going to be using the same set of pots to cook for herself as well as cook and sell idlis from Dharavi in Colaba. So what would you do then? The second thing is the importance of the work that the authors have done is that this allows us to peer into the asset composition of the poor households and provide us three key understanding. One is what is the role of access to financial services? Second is what is the extent of under-diversification that we see because these guys don't have access to a broad array of assets to hedge their risks. And lastly, and the most important thing perhaps is policy relevance, is the potential contribution of risk mitigating strategies that policymakers could take up. What the authors do to show this is to understand what could the household achieve at the same levels of risk, or if not the same, similar levels of risk, had they access to financial services. And it's an important counterfactual, it's an important theoretical, hypothetical counterfactual to keep in mind while understanding policy. And the key contribution, at least as my takeaway from the paper, was that the stylized facts are revealing in themselves, and the fact that they've attempted to quantify gains, or rather the welfare consequences of not having access to formal financial services in the poor households. Let's just go through what I thought was the salient features in their paper, and I'm going to pose some questions to the authors on that. This is an easy one, which is a housing an asset for low-income households? Sure, I agree with you that they draw down the value of the house over time, but if you consider the entire picture from a risk mitigation point of view, roof over one's head, regardless of what the labor income that they have, is indeed risk mitigating in some sense. So would you want to, it's harder to quantify the value of house vis-a-vis not having a job and still having a house, but I would urge you to try and probably have, it's only going to strengthen your results in seeing the alternative where you treat housing as actually an investment as an asset as opposed to a consumption asset. Jewelry in India particularly is hardly sold, and it's primarily used as an underlying for, say, a loan or the access to the informal sources of finance. What about existing loans of these households? In other words, if we are going to look at only the asset side of the balance sheet, it's going to be very difficult for us to understand what kind of exposures the households have taken on this existing really narrow set of assets. So in some sense, it's important to get the liability picture if one were to look at, and you guys probably are the only ones capable of showing some of that in India, considering, you have a very good data set. Thirdly, it's more of an open question. So in India, would you treat education as an investment or an expenditure? It's just a provocative thought in that the social structures would treat investment into a child's education as a pension plan, a very crude pension plan for the elderly once they grow up, because they have hedged their labor income by way of allowing their children to be able to fend for them when they're old. In which case, it's a tough challenge for all of us to understand and grapple with. But in developing country context, these kind of questions are very important to ask, because education cannot be quantified as an investment in other parts of the world for different reasons. So a well thought through categorization of what aspects of the non-financial world also contribute to their financial risk management practices will be very important, particularly in light of what you've quoted from portfolios of the poor as well, because when they're actively managing their portfolio, the active management is not just the money that they're borrowing and lending, it is also the choice that they make in the real investments that they do. So it's important to take that into account. I actually want to focus on this table for two very important reasons, which is if one were to understand how households mitigate labor income risk, it's a remarkable table that tells us that all the categories other than labor only, the investment assets that they hold are so closely, highly correlated with the labor income that they are actually going to end up receiving. So in other words, it would be nice to also try and quantify the correlation between their assets over time. Sorry?
The human capital.
That's right. So it's important to look, if you have estimates of their income, it should be possible for you to also see what the correlation over time between these two are, because that would quantify the extent of under-diversification that these households face. It is not surprising that the labor-only portfolio does the best, because the labor-only portfolio does not own any of this capital. And it's only natural to see that their returns on their investment would be higher than the others, because they're far more well diversified in terms of their position on the mean variance frontier as well. The hypothetical portfolio. I really liked the idea of the hypothetical portfolio, but that's exactly what it is. It is a hypothetical, in the sense that households often there is a lot of evidence from other parts of the world that says households don't always pick risk mitigating strategies. So the worrying question is, if you're talking about policy implication, is there going to be a choice to the household in what they're going to do? Because the hypothetical portfolio assumes that they're going to have a perfect financial portfolio that is of your choice. So, for example, there's a lot of good work by Stephen Hunt and a lot of others on rainfall insurance in Gujarat and about the uptake of the rainfall insurance product in Gujarat. Now, if you see, left to themselves, a lot of people chose not to take it up. In which case, how are you going to deal with that normative aspect of, when households make a choice, why do they not do it? The claim is that the portfolio witnesses a reduction in risk and an increase in returns. It's evident in the portfolio frontier, but I would also urge you to do statistical inference out of what is the significance of the difference between the two. I did a back of the envelope calculation. You are significant at 1%. The problem is you're using a median household, so you need to correct for that when you're estimating your paired tree test. The policy implications, unfortunately, to my mind, does not really flow from the study in a direct way. There are two-part assumptions in the policy suggestions that you're making. You're saying that we need to definitely step in to make sure that the households move on the frontier. The first part is that the only hindrance for the hypothetical portfolio is that there is no access to finance. While I agree with you that it's a large aspect, I also think households don't trust financial institutions, considering what they understand as finance are money lenders or other people who've only harassed them all their life, in which case trust in financial institutions play an equal amount of role in understanding how they're going to access finance. So in some sense, while I agree with the normative policy implications that you're stating, the study would not definitely lead to it. So I would urge you to reposition the paper as something that provides a stylized understanding of households in India, as opposed to something that actually leads to policy implication, because you can't attribute causation either. A few suggestions, and I'm going to wrap up with this. The self-reported income that you use to bin and categorize are notoriously, it's known across surveys that it's just very hard to get those estimates. So if you can, this is a crude way to understand whether, at least across different surveys, if you're similar. So if you look at the NSSO or the CMI consumer pyramids for these districts, and if you can see if the income distribution is broadly similar, it would improve and verify the veracity of your data provider's information on this front. Secondly, are these portfolios constructed before the investors offered the products? I'm not saying whether the investor bought or sold. So it's very important to understand whether you collected this information before the finance service provider asked them or told them about the various assets they could buy or not, because it affects the way they understand risk. So, if you could clarify that a little bit more in the paper, it'll be very useful. And lastly, it was very disconcerting that you threw out about a large fraction of your data. While you have 170, you have a lot more households than that, calling them outliers. I would actually urge you to reconsider and think of small, medium, large households within the context of these occupational categories to understand whether there is a different way in which risk mitigation helps across different buckets of income. And you guys have the opportunity, and I know a lot of work at the FRG in India also is beginning to do household finance. The ideal setting for this study is when household returns before and after the financial services provider started providing services is a much better, cleaner setting to understand this. And since your financial services provider has been operating for a long time, you do have some amount of information ex post. You may not have the ex ante part, but that would be useful. And if I may just wrap up by saying the most ideal study would be if you could randomly roll out access with a baseline and a post-rollout survey while you're trying to expand when the financial services provider is expanding. That would be the best estimate of understanding what financial access does to households in this country. Thank you.
Longer than what Vimal said. I am aware of how this data is being made. I know a bit about the way you guys are working at the field and obtaining this data. Nobody has the ability to get the full picture of households like you guys have. Okay, your opportunity is unmatched. So, for example, Vimal said we study stock market investors. Okay? I feel we don't know anything about stock market investors. We never see the overall financial portfolio of stock market investors. We are always seeing one tiny part of their life. We might see one account in NSDL of one household, of one person in the household. But there are multiple people in the household. They have many other assets which are not in NSDL. We don't know how to connect up 5 accounts by the same household in NSDL and so on. So we're always peepholing into a very incomplete depiction of the household. You guys have an absolutely unique position. You're actually seeing the household. Okay, and I'm aware of very few other data sets which are able to do what you can do. Okay. Now that said, I have many, many implementation problems with the rest of what you have done. And your work is very, very important. Don't see it as a sprint, see it as a marathon. Okay, I think you're lunging too quickly for answers. And I care about the same answers, but a lot of work needs to be done before you get to credible answers. So I just want to say I'm very sympathetic to what you've begun, but the cost in time and effort to get to credible answers to the sorts of things you're trying to do is probably 10x compared to where you are. So don't sprint to an answer. Take time. This is hard work. Go do the hard work. Okay, it's important. Now, I've one narrow thing to say about the actual work on the returns and all that. It is standard and well understood knowledge in the field of asset pricing that historical returns are truly useless for thinking about the future. Okay, so if you were to make an analogy, suppose you were working with individual stocks. Okay, suppose you take the last 20 years return on Infosys, and you take the last 20 years return on Reliance, and you take the last 20 years covariance between the Reliance returns and the Infosys returns, and you stick them into a little 2x2 covariance matrix, and you try to do some Markowitz type calculations based on that. That would be errant nonsense. It would be the most useless thing in the world, because historical returns and historical covariances are an extremely poor predictor of the future. We simply don't have enough data to pull these things out of data. Okay, so it's a long story, but I just want to summarize it to you in one line, that in any respectable setting, you would never use raw historical mean returns and covariances of returns for making any kind of Markowitz type calculation.
Covariances are okay. I think returns are the problem.
Even covariances, you get into curse of dimensionality type problems. So in any stock market, but the returns are completely useless. So you always have to take a call. You have to take a stand. You have to articulate an opinion about the covariance matrix about the future. Everybody, whoever makes a portfolio, has to take a stand. It can be model assisted, it can be your pure intuition, but you have to have an opinion that this is how I think gold will work in the next 20 years. This is how I think equities will work in the next 20 years. And you have to marshal many other kinds of evidence for forming those opinions, and you have to be unembarrassed to say it is an opinion. There's no running away from that. So there's a pseudo-objectivism that comes by saying, I took the historical data, it has 2 decimals to it. Jayant Verma is not here. Everything he said yesterday applies. Okay, so if you're going to make any kind of remotely credible Markowitz type calculation, it should not be with the raw historical returns. It has to be with a view about the future. This is my opinion. So for example, take gold. Actually, we have excellent evidence about long horizon returns on gold, and they're very different from what you have. Okay, so if you take 100 years, 500 years evidence on gold, the real return on gold is like 0. Okay, gold is not a great asset on historical standards, but you've got an extremely exciting return on gold, and so on. I mean, I could argue about many of the things. So you are sort of backtesting on the past. You're pretending the past will recur. But if I was just going to push that argument, again, in a single stock setting, if you're going to look at the past and you know what happened in the past, you will look at Reliance, you'll look at Infosys, which of them gave higher returns, you'll put 100% into that stock. If you had a time machine, you don't need finance.
Abhinav?
Great paper, actually, but just a quick suggestion.
Anita.
India is one of the most culturally and geographically diverse country. And you have Tamil Nadu, you have Odisha, and I think you have Uttarakhand. I don't know, I haven't seen your paper, but maybe you want to report the results region by region, basically. just to show the diversity, how things vary. Like climate is completely different what it is in Uttarakhand and in Tamil Nadu, and so is the social culture and way people perceive things. So you might want to give that thing a consideration that might bring in a diversity and maybe a robustness to your paper.
So I just have one question and one comment. So I've also done a lot of work on rainfall insurance in Gujarat, and there is a lot of basis risk. So it's not, maybe the returns are not as good as you might have predicted in the paper. So I would just encourage you to do some sensitivity to that return. And second, I think your paper broadly seems to say that there's a missing market, right? That poor households would benefit very much from these services, but they're not getting them somehow. And I think the main barrier so far has been the cost of provision, right? So it's really hard to distribute and then service these households. And so my question is, have you thought about what the net gains are? So clearly the households would gain from these services, but are there net kind of market gains from providing these services to those households?
I am V.V. Anand. Okay, can I?
So I'll just take forward 2 points that both Vimal and Anita made. One is that we're completely ignoring the credit, the loan side of the household portfolio. And as far as I know of, if this is KGFS data, then there is a huge prevalence of the JLG loan in most of these households. And a lot of things move along with, and a lot of access to some of the insurance and pensions products also moves along with the JLG cycle. At least that's what we see in some of the data. So I think that incorporating...
For those not in the know, JLG stands for Joint Liability Group Lending. These are the micro credit
right?
You're sitting directly opposite to me, I remember.
And so I think, in bringing that into the analysis and also asking which kind of households bought some of these products that have been sold would be very interesting and important. And yeah.
I am V.V. Anand, formerly of SBI and SBI Mutual Fund. See, this, in fact, complementing what Renuka was saying and what Vimal had also said. See, we actually launched something called Chota SIP 5 years back, Chota SIP, which was we allowed people, we said we'll collect thousands of them and then 100 rupees a month. That was the minimum. But in a mutual fund scheme. In fact, I was in touch with Mr. KP Krishnan and we got approval for PAN card waiver for lower value accounts. SEBI gave that. But with all that, what really happened was, see, these people want that when they have an asset, they should be able to borrow against it if there's an urgent need. And so some problems came up. In fact, the product didn't take off when we did it because we were in touch with, we did it through microfinance institutions. That's how we launched it. And there was one in Karnataka with whom we had a lot of, Dharmasthala, once big society was there. But what happened that now the mutual fund cannot itself provide the loan against its asset. And despite JLG and those schemes, because MFIs were bent on giving loans without collateral. But in fact, people like the commitment of doing something monthly. They like the discipline which this offers. And they would like occasionally to be able to borrow against that asset. And though cost is an issue, in fact, banks were very unwilling to take up thousands of these accounts. But cost can be addressed through technology. Now, many things have changed. At that stage, even simple opening of account, banks were very reluctant. They were dragging their feet. Today, that is all gone. So I think it can be done. But it will be important to package it. You see, the product as it is will not go.
Susan, Venki?
Yes. I think the collateralization is very important because these are not really substitutes in the minds of investors. A financial asset is very hard to collateralize for them. There's another thing on the trust deficit that Vimal raised. I've done some work on the informal sector and also the mutual fund investors. The realized returns are quite different from what you see as a buy and hold returns that funds put out. And largely it's because of timing. I mean, they're just generally, it's a push product. So most of these financial products have these intermediaries like distributors who sort of make the decision for them. And usually that is always in the interest of the intermediaries and not in the interest of the investors. So I think if you look at, I think this is a great study. I think this is a perfect start. But I think we have to learn a little bit more about why these people are avoiding financial instruments in the first place. And it seems to me like they're pretty smart. they figured out that the realized returns are always negative. So they would at least see something physical, tangible like land or gold, and rather prefer that.
Renuka?
One more comment, which is that while we've sort of spoken about this, but we're really going to get to the root of the matter once we start constructing balance sheets of the firms, and these are sort of discussions we've all had. But now that you've started this work, and in the spirit of running a marathon, I think that is where this work really needs to go.
Chirag?
I just have one small point, which is raised by Anita as well, regarding the costs of investing into these financial products, because the amount invested may not be too large and the cost might just be significant as a percentage of the amount invested. So it'll be just good to have that as well.
Yeah, Bhagwan?
So it seems to me that land is basically a hedge for non-traded consumption. And it's hard to get around that issue that, if the land prices go up, you have to live there, and if you own land, then you're hedged. So if you're going to switch land into some kind of a financial product, that needs to have a similar hedging capacity. And the second thing is jewelry. Jewelry is, I think, to me, Renuka, we should pay attention. That's the most important thing to replace, because gold, as you said, has really no returns whatsoever. And that's really the asset which substitutes for a financial asset. If you can replace that by a better asset, but keep some of the properties that gold has that are attractive, I think that will be the biggest innovation in my mind. Because think about it, a lot of people hold jewelry because that's what people want in dowry. Okay, so what's the best way to hedge it for your daughter's wedding? To have jewelry. I mean, that's what people want. Now, once people start accepting mutual funds as no, I mean it only half jokingly. I think that's we need something that is of the same tangible value. Then I think we will.
Yeah. So I remember some of the policy debates that we had around NPS, which is the National Pension System product that has been created specifically for the lower income households. This is called the Swabalamban product. One of the policy ideas was that if they are going to be contributing to this and it's got lock-in, you cannot withdraw it until the time that you retire. Perhaps you should allow payment or credit against NPS as assets. And then, of course, we'd have to design how it is that it comes into action when the person is going to default on the loan. But that was a real tangible idea because it encourages the long-term savings, plus it captures some of the collateralizability of the financial asset.
Yeah. Can I just one more comment about the insurance thing? I was a little, I couldn't understand why insurance would increase expected returns. That's a purely diversifiable variance reducing strategy. It should have no impact on expected returns.
Bhagwan, just continuing on the gold. My opinion is that for the last 50 years, we've run a monetary policy that gave high and variable inflation, and we've run financial repression, which gave negative returns on government bonds. So households, for a lot of households in India, you're presented with these polar choices of gold or equity risk. We're not being given that middle road. And the macro policy has to really be fixed. That is, we have to get to government bonds, which give nice real rates of return, and we have to get out of the inflation risk. Otherwise, the households are being asked to jump a chasm.
So why hasn't government thought about inflation indexed bonds or something? I mean, those have become quite common in the West, and it seems like an obvious thing for. I mean, I need to ask Raghu this question. What's going on? Are adjusted for inflation, our returns is -1. I don't get it. I don't get what's going on. So right? Inflation is 10%. Bond returns are 9%.
When something terribly obvious doesn't happen, you've got to get suspicious. So I think that.
So, okay, Bhagwan,
I agree with you. There's something going on that you're not getting. My simple conspiracy theory.
What is it? I'm asking you. Tell me.
My simple conspiracy theory is that when you've got a racket going called financial repression, why would you want to pay a higher real rate of return compared to getting a negative cost of capital for the public debt management?
Okay, I don't accept that answer. I think there should be innovation. We shouldn't rely on governments to be able to provide these things. I mean, there should be financial innovation that gets around this issue. I think all of us sitting in this room need to get to work and do something.
See, one other point following up on the gold thing is in a lot of surveys, people find these physical assets to be easily transferable across generations. And I think the current setup in the financial market is beneficiaries and it's a very harassing task. So given there's a lot of uncertainty about life in the lower strata, it becomes easier for them to hold gold and pass it on from one generation to the other easily without transactions cost, while it's very hard on the financial side. So that's another thing that can be surmountable, but I'm talking about the current constraints.
Yeah, but you know, gold is also easy to transfer to thieves and other places. So I think, yeah.
So, spirited discussion. I hate to stop it, but I need to give Vishnu and Rachit a chance to respond, and then we have to go for a lunch talk and lunch.
Thank you,
They've
everyone.
already said their piece, you know. They have nothing. Let's let other people say stuff, no? I'm just joking.
No, I'd just like to thank everyone for their detailed comments, especially Vimal. It's been great to have the opportunity to present here and to get all your comments. Thank you. We have nothing more to add.
Okay, Bhagwan's comment holds. Anybody else, or can we?
No, I just wanted to add that there are thieves in the financial market as well. So I don't think it really.
You know, and what is worse is you would. And what is worse is, at least, you know, when somebody steals your jewelry, you know it happened. With finance, you'd probably find out 10 years later.
Or 30.
You guys are such skeptics.
Oh, I can't help continue. Bhagwan, I would love it if we could innovate our way out of this mess. What we have is a repressive legal regulatory system that will make sure that you cannot innovate.
Screw them. You and I need to sit down and make sure it happens, you know.
What? There's no FSLRC pitch? Continue.
FSLRC?
Yeah, this is something Ajay needs to explain.
Is the solution to the repressive blanket of law and regulation that prevents all innovation in Indian finance?
It's actually a solution to a lot of mankind's problems.
It stands for the Financial Sector Legislative.
No, I know.
Yeah,
I'm just,
okay.